squad, right?
Madam Mariam, good morning. How are you?
Good morning. How are you?
Yeah, good. Thank you. Nice to see you again today.
Thank you.
You know, we are so used to those conventional blackboard, whiteboard learning. It's
Okay.
a new learning that we are talking to computers, phones these days.
Yes, we have taken in one of the big offices in Wakiso. Don't worry about the background.
Okay. So there are
Yes,
no politics.
Yesterday, we covered underwriting. We are going to finalize that topic today. And I'm glad to see that the class is now full. I hope you've remembered to carry your calculators and pens and papers because you're going to do some calculations. Yesterday, we covered underwriting. I think you remember that topic very well, the subtopic. And we said underwriting is a process of accepting and rejecting risks. So much as we are going to look at calculations, we are going to base ourselves on what we studied yesterday. Because yesterday we were in the theory, today we are going to go into the practical bit of it. We looked at the role of the underwriter, and we said he's the person who rejects or accepts the risk. And it's the person who rates the premiums. The other thing we looked at yesterday was the assessment and surveying of the risks and how to utilize the assessment report given to us. We looked at the sum insured and the limits and how they're very important in ranking and rating our businesses. And lastly, yesterday, we looked at insurance premiums. And under insurance premiums, we talked about how premium should be fair to all the people in that pool and how it should be suitable or equitable, and it reflects the true picture. Among the things under premium, which we talked about, were the other charges, where we said we have stamp duty, which is flat for people who have been already in the industry. For people who have just joined and you've been here for just 1 year, stamp duty and the training levy and value-added tax, they all came through an act. So unless we go back to the act, those three cannot be changed. For now, the stamp duty which is charged for all the policies is 35,000. And the sticker fee is charged for only and only vehicles. While the training levy, we use a 0.5%. And the value-added tax is an 18%, and as per the law, is under the Finance Act. Now, having looked at this yesterday, now we are going to go into the calculations. And our first calculation today is about someone who has a vehicle, maybe a Prado. And the cost of this vehicle is 20 million shillings. And then we have to apply a rate of 4%. The moment we apply a rate of 4% on the 20 million, we will get 800,000. Now, this 800,000 is the premium. It's the only money which belongs to the insurance company. It's the only money which the insured has entrusted to be put in a pool by the insurance company and to settle the claims as they come up in that pool. we go down and we charge a sticker fee, assuming what we are charging is a vehicle, just like I said. And the sticker fees is 66,000 Uganda shillings. What happens on the sticker fee? Insurance companies go to the Uganda Insurers Association. They purchase the stickers in advance and in bulk and keep them in their offices as working stock to be sold to the clients as they come in. So 6,000 therefore is a sticker fee, which is passed on to the client. Just like I said, as per the Insurance Act as amended, we charge a 0.5% for the training levy. And the 0.5% of the training levy is got from 800,000, which is the premium. Members note, we do not charge training levy from the sticker fee. Training levy is charged on the basic premium, which is 800,000. After charging the sticker fee and the training levy, we then have to add the totals, which is the premium of 800,000, the sticker fee of 6,000, and the training levy of 4,000. And we will get our figure or our new total as 81,000. The 81,000 therefore will be our basis of charging the value added tax. Members note, VAT is only charged on sticker fees, on training levy, and on premium. And then we'll get our value of 145,800 shillings as a VAT amount. After getting the VAT amount, we then add the stamp duty, because just like we said, all policies attract a stamp duty. Therefore, a stamp duty of 35,000 is then added. So for us to get what we call the total premium, we are supposed to give the client, we are supposed to advise the client, we are supposed to collect from the client, will therefore be the premium, basic premium, which is 800,000, the sticker fee, which is 6,000, the training levy, which is 4,000, value added tax of VAT, which is 145,800 shillings, and 35,000. And then we will get a new total of 99,800 shillings. Oftentimes, participants and our students make errors or mistakes, and we add stamp duty and we get VAT from a stamp duty. Please note, VAT and stamp duty are both taxes, so we cannot charge another tax on a tax. Just like I said, insurance companies are VAT URA collecting agents. So when we collect, we cannot therefore charge on another tax. Another thing, again, way mistake which is made by students, usually students forget to charge the training levy. Please note, if you do not charge the training levy at the end of the day, your calculations on premiums becomes wrong. It means you're bringing a financial loss, however small it could be, to your institution. So let's be very careful and let's be very alert, and let's charge these premiums as per the calculations I've given you. The calculation we've just done is for motor only, motor vehicles only. Let's look at what we charge if you're charging on a property. If the client comes in and wants property insurance, or fire insurance, or burglary, or all risks, the charges are different. Assuming the building the cost is 50 million, and this time around, we are charging a premium rate of 0.25%. Our premium therefore will be 125,000 only. This is the basic premium. I've deliberately put in the sticker fee, but I put in red and I put a word out because I do not want you to confuse the computations between motor and other classes. The training levy is charged across. So in this case, our training levy is going to be 625. We therefore add 125, which is the basic premium, plus the training levy of 625, and we will get our new premium of 125,625. On that amount, we then apply the VAT rate of 18%, driving us to 22,612. And that's the amount which is going to be the VAT or the value added amount on that particular policy. Please note, yesterday I told you VAT or value added tax, we usually give our clients a VAT tax clearance, and they reclaim that money back. The other thing, therefore, we then add a stamp duty of 35,000. So for this particular fire insurance policy, our premium therefore is going to be premium, which is 125, plus a sticker fee, which is a 0, plus the training levy, which is 625, our VAT, and our stamp duty. So for a building of 50 million, the client is going to pay only 183,237 shillings. Are you together? I need a yes or a no.
No.
Where, from where? Brenda?
Kindly repeat for me fire insurance calculations, all of them.
All of them.
Mm.
Okay. You have a paper with you, Brenda?
Yes, I do.
Good. Can I assume you all have a paper, pen and paper? Now, assuming we have a building, your house, the value of your house is 50 million. And for insurance purposes, we are going to use a rate of 0.25% for fire insurance. And if you are to use a rate of 0.25 for fire insurance, we then apply it on the 50 million, you will get 125,000. Are you together so far, Brenda and the class? I need a yes.
Yes.
Good. Since we are not having a vehicle, we are not going to issue any sticker. We do not charge sticker fee. So sticker fee for property insurance is completely out. But we have to charge a training levy because the law warranties that for all the policies, training levy is a must. And the rate for training levy is fixed. 0.5%. Therefore, our training levy fee is going to be 625 shillings only. We then add the total of the basic premium, which is 125, and then we add it on the training levy, which is 625, and we get 125,625. On that 125,625 is where we apply the VAT, which is a standard percentage of 18%. Are you together so far?
Yes, we are.
Good. We then get 22,612 for the VAT. Now, for us to get our total premium, we will then bring in stamp duty, which is a standard at 35,000. So the premium we are going to advise our client, therefore, is going to be the 125,000, the 625 shillings, and the 22 plus the 35. When you add all the four components, you'll end up getting 183,237 shillings as a premium the client is going to pay toward the insurance company on a building of 50 million Uganda shillings. Are we together?
Yes.
Good. Now that we are together, I would like us to take the next few minutes for the participants to do these calculations. The first person who does the calculation, you put up your hand and we see whether your answer is correct, and then we carry on the next team, on the next session. I'm waiting for a hand up. I'm giving you 2 minutes. We have two questions, question 1 and question 2. Let's do some calculations because that's where insurance companies are losing money by us charging premiums which are not adequate. Yes, Shama, your hand is up.
Yeah, I have the premium for the first one.
Yes.
It's 2413880.
Shama, how did you get that?
I did the calculation as you showed.
Yes, but you have to take us through the entire calculations. What happens? Your answer is right. But when you give your neck exam or a test and you just give us the answer down.
I have the process. The premium would be 2 million.
All right.
2%.
You get a mark there.
Then the sticker fees is 6,000.
You get a mark for the sticker fee.
Yeah, training levy will be 10,000 because it's 0.5% of the 2 million.
You get a mark there as well.
Then there's a total of 2016,000.
You get a mark.
Then there's a VAT of 18%, which is 362,880.
You get a mark.
stamp duty of 35,000. Then
You
the
get
total premium comes as 2413,880.
you get a mark. So, members, what happens if you just give us uh, if you just give us an answer the premium down, instead of getting 4 marks, you might end up getting a half or 1 mark. Why? Because if you look at the steps you're taking, they are like 6 steps, and we need to mark each level, because we're dealing with the calculation. And with calculations, we need to be sure that you've not copied a friend, or a friend has not given you the bottom line answer. Yes. Brenda, I saw your answer in the box, in the chat room. Can you take us through number 2?
Number 2, the sum
Yes.
insured is 70 million.
Yes.
Then the rate is 4%. This premium is 2,800,000.
You get a mark
Then the
there.
training levy is 0.5%. Then it becomes 14,000.
Another mark.
Sticker fee is 6,000. Then the VAT is 576.
Okay, now,
507,600.
Brenda,
Yes,
how did
madam.
you get 507,000?
Hello.
You've missed a step.
Hello.
Hello?
Actually, what I've done, I've summed up actually I've summed up the basic premium. Hello, are you
I
getting
hear
me?
you.
I've summed up the basic premium and sticker fee, then plus the training levy.
Okay.
Then I got the one I got. It was 18% of the VAT. That's
Brenda,
506,000.
Brenda, your
Hello.
VAT, Brenda,
Hello.
can you hear me?
Yes, I'm hearing you.
Your VAT amount is correct. But what I wanted in your calculation, I wanted you also to mention the 2.82, right? Where then you
Yes,
have
I'm
to
getting
apply the 18%. Your VAT amount is correct, but you had missed a step. And when you miss that step, it means you're losing a mark. So I need us to be consistent and we follow all the steps for us to get the maximum marks we need for a particular question. So members, are we all together? I'm asking someone else who is not Shama and who is not Brenda. Are you following?
Yes.
Yes. All right. Having looked at those calculations, I would then request you to mute all your mics, and we continue. Evelyn and Brenda, mute yourselves. Thank you. All right. Now, those are the calculations which we have to do when we are computing our premiums. Any step you miss, you're causing unintentional financial loss to your organization. Any space or place you miss or step, you're making a client pay less premiums. And when they pay less premiums, you risk being told to go back to that client and they make a top up, which will bring a negative name to the organization. So, having looked at that, therefore, we look at the component of the premium. Now, the premium which I'm referring to here is the premium where we charge the rate. The premium I'm referring to here is the premium which Shama has told us that it was 2 million. The premium I'm looking at here is the premium Brenda told us that is 2.8 million. The premium I'm looking at here is the premium which I told you that is 125,000 in our calculations that, as per that slide, or the premium of 800,000 again, as per that calculation which I put on the slide. So the basic premium component, therefore, must be adequate to cover the 7 areas. Area number 1 are the claim costs. Insurance companies exist to settle claims. That's the only reason why insurance companies exist. We collect money, put it in one pool, right? And then we start settling claims for people, and you're getting money for that, from that pool. So the premium charge must be adequate to settle those claims, number 1. Number 2, part of that premium must go to the management stroke operational expenses. Management operational expenses, we're talking about things like salaries, we're talking about things like rent, we're talking about things like transport, we're talking about things like utility bills, we're talking about stationery, we're talking about purchase of vehicles, you know, all those fall into the management or operational costs. And part of that premium is supposed to handle that. We get businesses from people, through agents, through brokers, bank assurance, and these guys are entitled to get a commission. So the amount of premium charged, therefore, has a component of commission embedded in. And that commission is paid by the insurance company and not the client. The other thing which comprises of our premium is reinsurance. And for now, reinsurance is the insurance of an insurance company. So when we get that money, therefore, we also give part of it to an insurance company which is helping us on that part of that risk. We'll look at reinsurance as we carry on before we close the day. Again, part of the premium is going to be profits. Insurance companies are set up by investors, and investors need a commission. They need to see a return on their investment. They need dividends, right? And insurance companies are not charitable organizations where they have to put in money and they put in and they put in and they're not pulling out. No. They need profits. Okay? And from the profits, they need to be paid dividends. Okay? For them to share part of their investments. Then, of course, we have to look at the issue of inflation. We know today, this month, if you follow the inflation rates, as per Minister of Finance or BOU, they keep varying year by year. So when we are giving a premium rate, when we are getting premiums, we also have to embed in an inflation which could come at a later date. Good enough, the Ugandan economy inflation rate is not high. It does not skyrocket. But we have countries like Zimbabwe, where the inflation rate skyrockets on a weekly basis, right? Here, we are still safe. And lastly, part of the premium goes to the reserves. Okay? And when we talk about the reserves, we are talking about those covers which are still, which we are covered, the policies which we are covered, they are still running, right? And we do not know whether we are going to get claims from those policies or not. But we cannot just assume that whatever we've got is our money, those are profits. No. We put some money aside to cater for the claims which will come in the insurance company after maybe the policy has expired, but it's within the agreed period, okay? Reserves for claims which were reported to the insurance company, but they are not yet paid because maybe the insured has not brought the documents or the insurance company is still investigating. So those are the reserves we're talking about. So the basic premium charged should be in a position to cater for all the for all the 7 areas we've discussed. When you charge little premiums, it means you're compromising your settlement of claims, you're compromising the profits, you're compromising the reserves, and you're compromising the management operational areas, because you might end up now, instead of being in very nice and representable offices, you go deep down and you get buildings which are bended, right? You get buildings which are in a sorry state. Why? Because the company does not have money to cater for offices which are presentable. As we are charging premiums, we have to be very, very careful. Are you together? Are you together? I need a yes. Good. Thank you, Shama.
Yes.
Thank you. Now, having said that, we are now going to another slide, which we call excess or deductibles. And I remember on Monday, I was asked whether there are areas where insurance can pay a lesser rate. And I said we would discuss it as we carry on. I think it was someone asked that question, but now we are going to look at it. However, for our insured to take precautions, for our insured not to take things for granted, for our insured not to be careless and reckless, there is a certain percentage which is borne by them for each and every loss. Okay? And that percentage is called an excess. And an excess is compulsory and is paid by the client on each and every loss. And it's clearly stated in the policy document in terms of amount and in terms of percentages. Okay? Now, why do we have to make our clients pay money and yet they've gotten insurance covers and they've got the insurance covers to be safe? The reason is, one, we want to control the moral hazard. We want our clients to be responsible and reasonable, because if we let us ourselves pay all the claims, it would mean they will have so many claims, and even some areas where they would have tried to mitigate the losses. They will just say, I have an insurance cover in place, the insurance company will pay, and then that's it. And I think you see people like in the traffic jam, where people drive recklessly. So if you have an insurance cover in place and you drive and now you start squeezing yourself in a very stylish place because you want to move, it will then make you get dents or damages, and you'll be the first person to pay. Because when we talk about an excess, that amount in most cases is a small amount, maybe 100,000. And what that means that for all claims which are below 100,000, the client will not come to the insurance company to be compensated. So if you're this reckless driver, and every time you're getting dents from borders, you're getting dents because you're passing through narrow vehicles, you end up paying that amount by yourself. And you only come to an insurance company if the amount has exceeded your excess. Now, that takes us to the deductible. And the deductible is usually a very large excess. A deductible is an amount agreed upon by the insured and the insurer. And certain claim losses are borne by the insured. Usually, deductible is given when we have a client who, one, is a big client and we took some cover on accommodation basis because we don't want to lose him, but the businesses are so risky, so insured it. So we put a deductible, and there are certain claims which he handles himself and does not come to the insurer. And there are those, when he comes to the insurer, they should be above that threshold. For instance, while we charge an excess of 100,000, we can say we are giving you a deductible of 1.5 million. And we will reduce your rate from say 4% to maybe 3.5. We've just gotten out to just a 0.5, right? And we are saying for all the claims which are above 1.5, you let us know as insurers. For all the claims which are below 1.5 under our deductible policy, you the insured, you have to cater for them, and you do not have to involve the insurer. For understanding purposes, I'm giving you an example of both, right? And the excess computation, which I'm showing you, the statement is for each and every claim, 10% or a minimum of 100,000 is paid by the client for each and every claim, right? So assuming there is a loss of 500,000, definitely the client will meet 100,000, right? And the insurance company will pay 400,000 less depreciations. The other thing, therefore, which we have to look at, is the claim itself. Assuming the claim is 990,000, because it's below 100,000, the client will not come to an insurance company. Rather, they'll meet it and they'll pay it themselves because it's under 100 shillings. It's 100,000 shillings. And the claim amount here is below 100,000. So you have to meet that. The other thing which we talked about now is the deductible. After understanding the claims computation, now we look at the deductible. And we are saying a deductible is a very large excess paid by the insured, and the amount is agreed upon by the insured and the insurer on each and every claim. And if you agree on a deductible of 1 million, it means all the claims below 1 million are supposed to be paid by the insured himself. They don't come the insurance companies. However, if the claim is above 1 million, for instance, our example has 3.2. If the claim is 3.2, then the client will meet 1 million and the insurance company will pay 2.2 less depreciation. Please note, depreciation comes in as part of indemnification. So it's something which we have to consider whenever we are settling a claim. Have you understood that point? Members, have you understood?
Could you please explain the deductibles again?
All right. A deductible is a huge excess. It's a huge amount of money where the insured and the insurer come together, right? And you agree. Okay, let me give it another introduction. Usually we have clients in the insurance industry, and this client is a very good client, and you've been with this client for so many years, right? And all the covers have been so good and the loss ratios are good. But there is one policy out of those many policies which you have for that client, which policy is a very high risk policy. And there are so many claims which come in for that particular client and they distort the entire book. So what happens in this case, the client and the insurer will sit and agree and pull out this one policy, okay? And it's taken on accommodation basis. Instead of canceling it and you tell the client, no, I'm not insuring you on this, okay? You take it on what we call accommodation basis. But instead of charging the normal excess of 10% and 100,000, you therefore tell this client that for this particular policy, we are going to charge you a different excess. And we have to agree between you and me on this particular excess. And that excess is going to be so high, not the normal one. So that's why it now gets a name, deductible. And this excess, since I said is high, like in our example is 1 million, it would mean that all the claims which are below 1 million, okay? In this case, the client is supposed to handle them. They don't go to the insurance company, they are within, they retained them. They did a self-insurance for that particular part in terms of excess, so they don't come to the insurance company. However, if you get a claim which is above that amount, then you go to the insurance company. And in this case, the insurance company will pay the claim amount which is above the 1 million shillings you agreed upon as deductible. Just like I gave the example, the claim is for 3.2 million, but the insurance company is going to pay 2.2 and the insured is going to pay 1 million. Are you together, Shama?
Yes.
Good. Has the rest of the class understood that part? Members, have you understood that part? I need us to move together. I will assume
Yes,
you've
madam.
understood. Okay. Then that's okay. Now, having looked at the excess and having understood the doctrine of excess and deductible, we then shift to another area which we call restatement of sum insured or limit after the loss. In most cases, we do have losses. In most cases, we do have our businesses and we do not want them to get claims. But what happens in this particular scenario is when our businesses are hit with so many claims or with big claims, and every time you're hit by a claim, your sum insured limits keep dropping, right? So at a certain time, you need to restate back your building. You need to restate back your sum insured to the original amount because you do not know other claims when they will come in and which magnitude. So if you just sit back and wait, at the end of the day, you might find that your claims are so huge, right? And you did not restore back the sum insured. So the insurance company, being that they've been paying partial claims on that particular subject matter of insurance, you end up now compromising the entire thing. Please note, if it's a building, rightly so, we know you'll go back and you will fix back the building. But if you fix your building and you do not tell the insurer that you fixed your building, the insurer will take it for granted that you've not fixed it. Navin, kind of switch off your mic. Kind of mute. All right. Now, what I was saying, when the building, if you don't advise the client, it would mean that the value of your building has dropped. But whenever you advise your insurers, you pay an additional premium to take back your property to the initial or the original subject matter and the sum insured limits which you agreed upon. So it's very, very important for you to keep agreeing and adjusting your limits with your insurer in the event of a claim. You restore back your subject matter of insurance to the original position you agreed about, okay? Now, usually this is done if the period remaining for expiry is outstanding, okay? If it's 1 day, 2 days, and you have a claim, that's understandable because you're still in the process of working it out. When you restate the sum insured, it means therefore that you have to pay an additional premium. And the additional premium is paid based on the remaining period to expiry. You just don't pay the whole amount. You pay on the additional cover for the amount which you want to restate, 2 for the remaining period. Those are the two things which govern restatement. Now, having said that, we then look at our example. And we are saying the property, our property was at 50 million. And out of the 50 million, there was a claim of 20 million. So basically what this means that your property is no longer 50 million, but rather 30 million. So for that drop of property value from 50 to 30 because of a loss, it means when the insurer pays you, when the insurer indemnifies you, when the insurer compensates you, you're supposed to write back the 20 million at an additional premium, which usually is little money. If you do not do that, it means if you get another claim, that claim is going to be based on 30 million because you did not restate it back to 50 million. And when you talk about 30 million, it means the insurance company will just take it that there is an under insurance. So when we are advising our clients and their losses, we should take them through this line because in most cases, we forget and they get claims and claims are compromised and they end up getting very, very, very upset. So how do we restate premiums? Our property, which we've been discussing, was at 50 million. Our premiums was calculated at a loss rate of 0.25%. The period of insurance was from January 1, 2020 to January 1, 2021. However, in the month of July, there was a claim and there was the main period was 5 months. And the claim which we were talking about was 20 million, okay? Which means that we need to write back the 20 million using the same rate of 0.25%. And our annual premium, therefore, would have been 50,000. However, since we are going to do a prorata for the remaining period only, which was 5 months, we therefore need to look at 50 million over 151 days, right? And we know a year has 365 days. So we are going to look at 50,000 over 151 days divided by 365 days, which is the year. And then we will get a premium of 20,685,000 only for our client to write back his 20 million, to restate back his property to the exact sum insured of 50 million. Now, because we're talking about restating back and we're talking about an income to the insurance company and we are VAT agents, it means training levy has to come in, VAT has to come in, and stamp duty must come in. Therefore, our pro rata premium will therefore be 59,530. Are we together? Yes, Shama, your hand is up.
Yes, for the training levy, which premium will be used for the calculation? How did we get 103?
How did you get?
The 103 of training levy.
The 103 on the training levy.
Yes.
We got 103 of the training levy because we used 20,000.
Okay.
20,685 shillings.
Okay.
Remember, we are prorating. Right?
No.
John, kindly switch off mute. Yes, John.
I'm trying to see where we get the 20. When you go to prorata premium, I'm asking myself, where do we get the 20 million times 0.25%?
20 billion was our
20
claim.
million was
Remember
the claim.
this? Remember this? I've taken you back the previous slide.
Oh, okay.
Yes.
Okay.
That's where we got the 20.
Okay.
Is it okay now?
Yeah, it's fine now.
All right. Any other hand? We are together now? Good. Now, let me see in the chat room. There is a question. All right. About restatement. We are trying to restate back our sum insured, which we started with, but because we had a big claim which affected our sum insured, we want to get it back to the original sum insured. So we have to restoring it back or resetting back to our initial premium or sum insured is what we call restatement. We want our property to have the exact figure, a true representation of exactly the amount we started with. January 1, our yielding was 50 million. Because of 50 million, our business has been dropped to 30. But the insurance company has paid us. So it's just fair for us to go back to the insurance company and tell them we've fixed the building and we need you to restate it. And we do it by paying an additional premium. Now, for insurance, there are what we call long-term agreements. Remember, we said the general insurance is arranged on an annual basis. And since it's arranged on an annual basis, it means after 1 year, it expires. But now, we have organizations which will give you, you'll negotiate business, you enter into business, and they'll say, we are going to insure with you for 3 or 5 years. Those are what we call long-term agreements. And with long-term agreements, much as it's automatic that you have to renew, but you need to engage the client on an annual basis on the renewal terms. Why do we do that? Because we need to know the additionals. We also need to know whether there are changes, right? We need to know negotiations, and we need to engage them and then give them fresh contract until 5 years elapse. Okay? Now, usually what happens on long-term, insurers give a discount. Okay, why? Because some organizations pay premiums in advance for a specific period. And when you're given this money, naturally you invest it. Okay? And when you invest it, it keeps yielding interest. And when you look at the combined interest you've got vis-a-vis the discount you've given, the insurance company gets much more, so we usually give a discount. But you need to look at the amount involved. You just don't discount. And under this, both sides benefit. The insurance company benefits because you're assured of this business throughout, right? The client benefits because they know they have an insurance company in place, and come what may, it will always be there for them, and they will not go into these nitty-gritties and the administrative cost of running up and down every time they need a cover on an annual basis. Basically, that's what we look at when you're talking about long-term agreements. All right? Sorry, I am in the chat room. I want to see what's there so that we move together. We have a question in the chat room. And the question goes, does this mean that after reinstatement, the premium, if the client puts in a claim within those 5 remaining months of a policy worth 50 million, the insurer will pay 50 million or top up of the previous claim paid? When you reinstate the cover to the original 5 million, the insurer will pay 50 million less depreciations and excesses. I've handled that question now. So let's continue. Let's continue to the renewal procedure. Now, we have now to look at what we call the renewal procedure. And we know we are in an industry which is very competitive. So sitting back and you think the client loves you so much, they'll be coming and running to you is very wrong. What happens? You have to engage your client a lot. And we have the renewal procedures which we should and must be following on each and every client. What happens? There are 3 steps, and the 3 steps must be adhered to by the insurance companies. The first thing we have to do before, as the policy is approaching renewal, say after, let's look at 60 days, you pull out the file and you review. And when you're reviewing as an insurance company, you have to look at how has this client performed in terms of claims, right? In terms of how has he been serviced, in terms of premium payment. Okay? Now, and must you depreciate his policies, or you want to appreciate them? So when you're reviewing this file, those are some of the things you look at. And when you look at them, you then suggest to the insured what must be done. The review is done by the insurance company. If that's done and you're done with the review, then you write to the client advising them about their policies which are about to expire, right? And when you do that, you indicate the new premiums and you indicate additional conditions, if any. For instance, if these clients' loss ratios were high and you want to revise the excess upwards, it's through this invitation that you advise them that come next year, your excess is going to go up because of the many claims you've lodged in. Or I am going to review your rate which I gave you. Why? Because of the claims which you lodged in. Okay. The other thing, therefore, which you do after the invitation is to send a renewal notice and you introduce the new terms and conditions. You take the renewal invitation to the client and you discuss it with him. Please do not leave renewal invitations on desks. Do not WhatsApp this invitation and you sit back and relax. We are in an industry where we are so many and we are fighting for the same clients. If you relax, someone else is busy on the client's door knocking. And they'll think about someone who's really on their neck. They'll not think about you because you yourself, you've not given yourself and you've not prioritized this client. You're taking this client for granted and they will not like it. Nobody wants to be taken for granted. So when you send a renewal invitation, if it means calling this client on a daily basis or every after one day, please do that, but don't sit back. Now, step 3 therefore goes to acceptance of the renewal invitation. And when we talk about acceptance of the renewal invitation, we are looking at the client saying, yes, I want to renew, right? And I want to renew as per the expiry terms and conditions, or I'm increasing my business because ABCD happened, right? They'll advise you, and when they advise those changes, please note, they should and they must be in writing, not verbal. Because if it's verbal, you'll have a hard task of convincing your underwriting department of the changes. You'll have a hard time if there is a claim and maybe in between you misinterpreted what the client wanted. So it's very, very, very important that their acceptance is in written for you to be in a position to capture all the changes, right? And then you have to advise on the premiums, and you have to request them to pay the premiums. Okay? For the bankers, usually their policies are renewed automatically, which is okay because banks pay premiums. They're not culprits. But nonetheless, you have to engage the client, you have to engage the bank, and you tell them about those renewals which are falling due. Because again, if you don't advise the bank, they can also place it elsewhere. We are so many. The other thing we are going to look at now is the reinsurance. Okay? Remember, we said amongst the first premium, reinsurance is one of the 7 components which we have to look at. Okay? And reinsurance in this case, where we are getting business from clients and we are insuring them, insurance companies also seek protection from big organizations or similar companies, right? Depending on the type of reinsurance you want to go into. We need to seek that protection, and we also need to improve our balance sheets. And we ride on the balance sheets of big companies. Okay? So there are 2 types of reinsurance, really. There's what we call treaty insurance, and there is what we call facultative reinsurance. The treaty reinsurance is an agreement which is discussed and negotiated in advance. 4 months in advance. And insurance companies usually by the month of October, you know the insurance companies you're going to deal with, and you've already submitted their proposals and their slips to IRA to go through, and then they advise you. And usually this is done in October. So you have October, November, December for something which is going to run in January. Those are the treaty reinsurances, and the conditions, right, are clearly written, and both the insurance company and the reinsurer must agree on them before placement. And then the cover is automatic. Whether the insurance company has gone somewhere and they've written bad business, a reinsurer cannot say no. That's bad business. Why? Because you signed a treaty in advance accepting all the businesses which are going to be given to you by that particular insurance company. Regardless on how bad it will be, you'll take it up. That's reinsurance, treaty reinsurance. However, when it comes to facultative reinsurance, the treatment is totally different. On facultative reinsurance, insurance companies are approached individually, and it's a case-by-case client, and the reinsurer has a right to say yes or no. It has the right to accept or reject the policy you will be giving that particular client. So the difference between treaty reinsurance and facultative, one, treaties are arranged in advance. Facultative is treated case by case. Treaties, premium is given after 15 days of a lapse of a quarter. Facultative premium is given there and then, right? Treaty, you cannot decline any business. Facultative, you can decline a business if you think and see that does not follow within your underwriting guidelines. For understanding purposes, therefore, we have a computation of reinsurance. And the company's retention for this ABC, insurance company's retention, is 100 million. This is the amount that insurance company is comfortable to pay out on each claim. This amount, the insurance company is okay to not jeopardize its financials. However, they got a business of 230 million, meaning the business which was got is beyond their comfort zone. So if the business got is beyond the comfort zone, therefore, you have to look for someone who can help you to take the overage. In this case, which is 130 million. Okay? And then you can either do it through surplus or through facultative. Surplus is a treaty. And then premiums are going to be paid by the insurance company to the reinsurer and not the broker, and not the client. Reinsurance premiums must be paid by the insurance company. That's why on the premium computation, there was a part for insurance. The other thing the insurance company does, it gives the insurance company a commission and an administrative fee. Why a commission? Because the insurance company must have paid a commission to a broker. Naturally, that amount is supposed to be recovered. But also the administrative cost of running up and down. This company therefore pays claims less the retention amount. And for the example which we had previously, the retention amount